Last week's non-farm payroll numbers came in weaker than expected, which got everyone talking about the state of labor market and what it could mean for the Fed. This softer data led to some market swings as traders tried to figure out the Fed's next move. In today's video, we'll break down what happened, look ahead the key events on the economic calendar, and dive into some charts to help you navigate the markets this week. Hello everyone, I'm Güllüoğlu. Welcome to another episode of Market Update. So let's first of all begin by reviewing the key events from last week. While evaluating this like a key events last week, I'll use the QQQ Nasdaq 100 index ETF chart to show how last week's data influenced market prices. So at the beginning of the week, first of all, we received manufacturing PMI numbers, which like across the globe, like from Europe, UK, China, and stuff, and it signaled a contraction in the economic activity. As you can see here in the QQQ chart, the manufacturing PMI bar, that Tuesday, is like this, and there was a huge sell-off. So generally, QQ includes the large cap, mega cap tech stocks, that Magnificent Seven. So it reflects the activity in those equities. That's why it's like a great indicator to see market response to such like a news and like a market's reaction, the ongoing sentiment, risk on or risk off sentiment. That's why I picked this chart. And as you can see, after the manufacturing PMI, there was around like a it's around like a 3% sell-off in the day that the data released. That fooled recession concerns. That's the issue. In the current narrative, just as a reminder, I keep repeating in all my videos that any bad data related to economic activity supports the idea of potential recession and triggers a shift towards risk-off sentiment. So then we received on Wednesday the JOLTs job openings report, which came in below expectations and lower than the previous number, signaling that the cooling in the economic activity and like a labor market is continuing. After the data release, US 10-year yield dropped by 6 basis points. And the details of the data, when you check the details, job vacancies declined, hires increased, and quits remained steady. Like there is no indication here of a sudden collapse in the labor market or like a urgent recession warning or something. But while openings have dropped significantly, there's still like above a 2019 average, like before pre-pandemic. That's the benchmark that while we evaluate such data. So hires and quits ticked up a bit like last month, but both are like below 2019 levels. Like the vacancies to unemployed ratio has largely normalized in recent months. So actually, there is no need to panic. JOLTs actually didn't indicate any like a urgent situation about like a labor market or economic activity signaling a recession or something. That wasn't like that. So after such data, okay, that was the headline number was below expectation, but with the details, the QQQ chart here in this Tuesday, Wednesday, and so Tuesday, Wednesday, Thursday, okay. Both we received JOLTs data. I'll come to Beige Book and ISM Services data. QQQ managed to hold. And if we take a look at the Beige Book, although there were no recession signals in the Beige Book, there was a deterioration compared to previous report. The Fed's Beige Book noted that the 9 out of 12 Federal Reserve regional districts experienced flat or declining economic activity in August. And also about the Beige Book, there was I'll like to show this chart about Beige Book. As you can see here, this is Beige Book activity in index, and you can see the decline around here. It's just like around like a zero level, but just to show this deterioration in the Beige Book activity. Yeah, coming back to last week's calendar. Then on Thursday we received ISM ISM service numbers. The market's initial reaction was influenced by the headline numbers, which was like higher than expected, and also new orders coming in above expectation. That was a good signal about the health of the economy. However, the employment details for July came in below both previous months and expectation. Here you can see, as you can see, this was the employment part in the ISM service data. Hiring freeze in place, not backfilling position as people are laid off, retired, or leave our organization. So that means when someone leaves, it's not like filled off immediately. The pace of this activity has come down, and that's concerning. In that, so what I'm trying to say, what I'm trying to say is despite the fact that the ISM service headline numbers seems good, in the details, in the employment side, since the employment is the major thing to watch right now, the economic activity side is the major center of concentration right now. The employment section of the ISM service report was the most important part, and it showed deterioration as well. So overall, until the end of Thursday, last Thursday, as shown in the QQQ chart, the sell-off was contained following the ISM manufacturing data. After the only sell-off was ISM manufacturing data up until the end of Thursday. Then the market then stabilized a bit with better than expected headline numbers in ISM service, but that was definitely it was not enough to recover from that level. So at the end of the week, on Friday, we received Nonfarm Payroll numbers as shown in the table. The headline figure came in below expectation. So I would like to point out the important details from about this NFP non-farm payroll numbers. The note that I wrote in the latest Rationale Trade Ideas Equities report. Let me show you that site. Here is the, by the way, website of Rationale. You can check equities report, FX reports, there's a trade alert reports and stuff. Yeah. In the last Trade Ideas Equities report, let me go through this note. First of all, the headline number is 142K level, which is below the 12-month average. Economists had projected 165K new jobs. Okay, headline number below expectation. What are the other important points? First of all, downward revisions are really important. I was highlighting a lot in my previous videos about non-farm payroll that these downward revisions were continuing with in each month we received downward revision for previous months, and also there's a metric. It's a 2-month downward revision average kind of metric that you can track. That it kept coming down. That was the risky part, and in the recent data we also saw this one. the previous month number was 114K levels, but it got revised to 89K levels. And also, as you can see, the 2-month payroll net revision is minus 86K with a prior number of minus 29K. Also, another important point is change in private payroll came in below expectation. That means when you also check the ISM service, that hiring freeze section, this backfilling position sites, that also supports this idea. But here, what I'm trying to mention is, generally there has been a debate about the financial tightening in general has taken place in private sector rather than the government sector. So it wasn't supported. I mean, the government kept increasing its treasury auctions, but through that way they were actually easing. So while the private sector side was tightening, the government sector was supporting the economic activity, and with that mentality, the Fed was there were debate about this, and they were Fed was they were the market. I've seen some reports that were judging Fed about that in general, it was contradictory with the tightening mentality. Fiscal side was not tight enough, and with this report, this idea actually is supported, and that might be an explanation why the economic activity is still up, and let's not say up, but at least holding. Now, with this backward previous months downward revisions, seeing deterioration in the private sector, probably we're going to see some layoff in private sector. Those will be concerning. So general mindset is, the way of evaluation this is, the main question: if the Fed is going to cut rates by 25 basis points or 50 basis points in the September meeting, that's the question. So after the data, actually, the chance of 50 basis point has increased. When Fed goes for to 50 basis, in consecutive 2 months or something, that might signal a panic mood from Fed. In order to avoid such situation, with a proper communication, or they need to prepare market for it. They need to signal this 50 basis points in order to avoid such panic. Because if we see such panic, that will lead to a huge sell-off in let's say equities, because that will be mindset. The mindset will be okay, Fed, I think Fed is lagged again, as it happened in March. They announced that the inflation is sticky in 2021 November, but they increased, they did their first rate hike in March 2022. That means their reaction was a bit late. Okay, now when we come to a current situation, if we see without any communication making a 50 basis points or consecutive 50 basis points, not for September, that might lead to some panic, okay, they're late again. In that situation, we're going to get into recession, and then risk off position will, risk off mentality, risk off sentiment will be intact, and that might lead to a huge layoff. But with a proper communication, and that would push markets to more a soft landing scenario. And in that scenario, I think that would be that might create some buy the dip opportunity in the stock market, or in that scenario, the current selling wave in the stock market would be unlimited with a market correction. So overall, for now, I think it's time to sit back and patiently watch for a potential buy the dip opportunity. But like some quite like now the question arises that buy the dip, but what to buy? That's the issue. So yeah, coming back to coming back to this, like what to expect for now, what to do for now. Sorry, yeah. Here, this is like this week's economic calendar. This week economic indicators mainly focus on inflation. So unless there are unexpected surprise with inflation, the financial markets might pay more attention to a few labor market indicators. And with the FOMC entering its blackout period, they don't do any comment about market before before the September meeting. Markets are more that silence might lead to volatility. But as I said, the main question, what's next now? Okay, maybe buy the dip opportunity might arise, but what to buy? So on the stock side, the normalization of the economy is expected to lead to broader market participation. Just remember, before the previous non-farm payroll data, the weaker than expected, this deterioration in the economic activity started with that data. Just before that, we were just in the middle of sector rotation. This means that the value stocks and mid caps could become more prominent in the short term, focusing on buying dips in defensive sectors like utilities, infrastructure, healthcare. It makes more sense to me. Value stocks, especially in the financial sector, may outperform growth stocks for a while. As hiring, inflation, and interest rates stabilize, we could see a broader range of stocks contributing to market performance, rather than just a few large cap stocks, which are already overbought. This would be true in a soft landing scenario, where inflation decreases without significantly affecting economic growth, leading to a more stable investment environment. So let me just show you this with a few with a chart. Here, yeah, okay. This chart is, let me show you what is this. VTV is the value stock ETF, and VUG is Vanguard Value Stock ETF, and VUG is Growth Stock ETF. And I took the ratio of these two, and in the daily, let me show you. Look at this one. After a huge rally, a bull market in the high, large cap in tech stocks, there's a really nice consolidation phase is forming right now. And a potential move up until that, 0.48 levels would lead to a head and shoulder bottom chart formation. And it's really clear if it works. So I think that's really, and also as you can see now, the chart, the price, the ratio is above its 200-day moving average, which is this red line, the 21-day moving averages. This gray one is 10-week and blue one is 50 MA. And as you can see, it's all the price is above all moving averages. That's really a good sign also. And this is really, I think, a sensible way to follow this transition. And what are the defensive stocks indicators? For example, let me show you this consumer staples, which are a more a daily usage, foods and beverages stocks ETF. And as you can see, this is in the weekly chart. Look at this, a strength. It's really powerful. And just as an example, for example, Coca-Cola company, it's a good example. In a weekly chart, in a daily, a sell-off with this non-farm payroll. But as you can see, let's check the volume also. As you can see, huge sell-off volume. But despite the fact that we see huge selling volume, the stock managed to stay above its a 21-day moving averages. It's a sign of strength. And also, I think there's a nice trading opportunity here in the Costco. It's not a perfect one, but like cup with handle chart formation kind of, and like and maybe a breakout around here could be like might be a nice trade idea, or just like this might be evaluated as just before forming cup with handle pullback to short-term moving averages. That sometimes I do risk some portion of my portfolio for such setups. But with this mentality, buying the dip, not the dip, but being in the stock market in the defensive sectors, I think Costco is a nice opportunity. Also, Walmart is another one that you can see. Look at this, like after huge earnings gap, we're above short-term moving averages. I would like to see some more consolidation around here to be in, but yeah, just to keep in mind. And yeah, coming back to economic calendar. So this was the stock side. And in general, I still believe that, as I keep mentioning in my previous video, whether we're in a soft landing or hard landing scenario, gold remains strong as short-term investment choice, I guess. It seems like the safest bet in the current environment. At least I don't see any reason to sell gold. That's why my mentality is any kind of correction in gold is a buying opportunity. And let me show you gold chart. Yeah, this was the way I was looking. Like, yeah, the main movement is here in the monthly chart. You can call it cup with handle, or I don't know, like you can call it like head and shoulder continuation. I think both are fine to me. And in the weekly, as you can see, we're above, it's like a 10-week moving average, and potential correction around like let's say 2450 levels might be might like any pullback, like trades like this with a tight stop might be evaluated. And lastly, on the FX sides, generally what I see is like the still carry trade activity is still ongoing, which I believe is contributing to the continued sell-off in like a large cap growth stock, like those particularly the Magnificent Seven. So we're in the transition period where funding currency is shifting from Japanese yen to USD. So my instinct is to be short on USD across various currencies. This means that any like appreciation in US dollar is seen as selling opportunity as long as it is like supported by like technical factors. Let me try to show you also this mentality in few charts. First of all, to show the carry trade activity after this like sell-off, like we're still, I mean, these levels, the level like 140 levels for USD yen will be crucial. We might see some consolidation around here, which if we see a consolidation, we might see some like this kind of movement. And if we see the continuation of the carry trade activity, then that would lead also head and shoulder top chart pattern. And in that scenario, that might be being seller in USD and also might be a good option with a stop above this consolidation. I don't know how is this going to be constructed, but yeah. And this is the way that in the weekly chart, I follow dollar index. As you can see, after the breakdown, a consolidation, a pullback to these levels, it is seen better in Euro USD. This trade idea is something like I keep mentioning. And yeah, as you can see, this is a weekly chart. When you come to daily, It's like, and also we have an ECB on Thursday, and like the rate cut is expected. It's like definitely we're gonna see a rate cut there. I think that's the reason of the sell-off. But I think relatively US side will need to be more, let's say, dovish in the upcoming weeks. With that mentality, I would be like at least I would be like trying to be long in here around this levels. Let's say, I don't know, just as an example, to be long around here with a stop around here. As you can see, 1.11% risking, and yeah, sorry. That might be evaluated like this to be long around here. Yeah. Overall, I don't know, like FX side also was like this. Like, so I mentioned like precious metals, FX, stocks, the way that I monitor. So in general, that's overall, like that's how I evaluate current like market condition. And that's all I'm gonna talk about this week. Thank you for your patience. Thank you for your watching. If you like whatever you see here, please like give it thumbs up, and please subscribe to Marketsall YouTube channel. That means a lot to us. And I hope you have a great week. Have a good day.